This is Brandon Steele. Welcome to Money Talk, a Mainsail Financial Group podcast series. Today we are super excited to have Rob McGarty join us. He's going to talk a little bit about interest rates and the impact of Seattle housing, and so I'm very excited to dig into the topic. But before we get into the meat of things, Rob, you want to share a little bit about what we're drinking here for coffee and where we're at today?
Absolutely. Thanks for having me today. We are at my office. We are in technically Wallingford. It's the north end of Lake Union, right next to Ivers on the lake. And today we're enjoying some coffee from Lighthouse Roasters, my favorite coffee place. So thank you so much for bringing it.
Yeah, of course. And Rob is a real estate agent with a boutique firm just out of here in Seattle. Focuses a lot on client service, from what I understand. And I can tell you firsthand, some of the resources that Rob puts out there is just amazing. So really excited to be able to pick your brain a little bit today. We've seen a big increase in interest rates, and so we want to talk about how that's impacting things and kind of what you're watching ahead.
Absolutely. Yeah, thank you.
Yeah.
So like Brandon said, we're a small firm, basically just this little tiny office here, and we have a small team that just focuses on delivering amazing client experience, and we're almost exclusively referral and repeat business, and that's sort of our goal. Is just have the same clients keep coming back.
All right. Well, and maybe to get us started, I know you've been busy, to say the least, lately. Can you talk a little bit about what we've seen in the Seattle housing market up to this point, like the last couple of years?
Absolutely. I think the best thing to do is actually take a little trip back in time. And I think if we roll the clock back to 2018, it's going to kind of set the stage for what's been happening. So in the spring of 2018, we saw a massive run-up in both housing demand and interest rates. So Amazon was growing rapidly, tons of buildings being built. Rates were kind of in the threes, and then they were working their ways up to 5%. And it was almost right about this time back in 2018 in May where rates started hitting 5%. The bidding wars were going crazy, and buyers were starting to second guess what was going on. And then at the same time in Seattle proper, City Council had just passed the Amazon head tax, which was a tax specifically designed for Amazon. And that was the first time Amazon ever came out publicly and said anything negative.
I remember that.
And so we went from bidding wars of 10 plus offers every single house, every single week, to Amazon coming out and saying, hey, we're halting all hiring, we're halting all construction, full stop. The next week, we saw basically every house get 0 to 1 offer out of nowhere. Nobody saw it coming that quick, but when you step back, it was a combination of everyone freaking out that the biggest employer was stopping, and then people were also stepping back and looking at, wait a second, we're paying, interest rates have now gone up to 5%, monthly payments are huge, and the prices have also rapidly appreciated, so everyone's put all that together and just kind of hit pause.
Yeah. Was that, sorry to interrupt you, was that during the taper tantrum from the Fed? Does that sound right? Did that line up with when the Fed was starting to raise rates back then too?
Yes, there was a little bit of rate there, and so that's also another great question as well, and we let's quickly sidebar into that. So the Fed rate hike does not directly correlate to a mortgage rate hike. So if you go back and overlay Fed rate hikes and mortgage rate hikes, they're definitely directionally tied, but they're not in lockstep.
Sure.
So once the Fed raises rates, mortgage rates don't go up. Typically what we see is mortgage rates are actually, I would say, leading Fed rate hikes because all the news out there is impacting all the other things that price mortgage rates, which are really mortgage-backed securities and bonds, and you know more about that than I do. It's still all a little bit of voodoo for me, but then that Fed rate hike, when there's so much news about it and people are pricing it into those other commodities, that's what impacts the mortgage rates. There was some, I think there was some Fed rate hike stuff going on as well. And then on the demand side, we just saw the Seattle market really cool down quite a bit. And so throughout the end of 2018 and into 2019, things were starting to be a very different market. And actually heading into the end of 2019, things were really slowing down. We always see a little bit of a seasonal slowdown heading into the holidays, and then things usually pick up in January and February, and we start to get that spring market going. But coming into January of 2019, at the end of 2019, coming into January, February of 2020, it was a little slower than the years before, because things were starting to level out a little bit with the changes in Amazon and that kind of stuff. And then COVID hit.
Right.
And then everything stopped. It was just full stop, crickets. Everyone got sent home. We were sent home. We were quickly declared essential. So we had that. We were back out showing houses, selling houses. It was really tough the first month or two. Nothing was really happening. Everyone was kind of freaking out, trying to figure out what was going to happen. A lot of people selling because they're just panic selling and want to get out because they think there's going to be a big problem. And then as we got later into the year, it kind of transitioned and everyone realized, wait, this is going to take a long time. We need more space. We need more house. We need to get out of this tight place. And the market started to take off. And it was just up and to the right all of the rest of 2020, all of 21, and really up till recently, it has not stopped. I think a really good chart to look at for that as well is if we look at seasonality in our market. As I was mentioning, it starts out in January a little bit slow, starts picking up, gaining steam through May. June is sort of the peak in our market. And then usually July and August are pretty slow here because we finally get to see some sun. And everyone's out wanting to take advantage of that. And then we come back after Labor Day and it's almost like people forgot to buy a house. And we see this huge uptick in demand. And then once we get to where it starts getting dark early and wet, it tapers into the holidays and we repeat the same cycle every year. Except 2020, we saw the cycle start, flatline, and then it was just straight up the whole year. Didn't stop for any holidays. Like usually we got Memorial Day coming up this weekend. We're feeling pretty quiet this weekend. Not a lot of listings came on, not a lot of activity the second half of the week. But 2020, it didn't matter. People were out desperate to get a house. Same with 4th of July, same with Labor Day, it didn't matter. 2021, we started to see a little bit of that seasonality come back, but it was still ignoring all those bumps. And so far this year, we've started to see dips along those times where we usually see it. So like midwinter break for schools, President's Week, which is usually around midwinter break depending on the school, spring break, and I think we're going to see that this weekend with Memorial Day as well.
Okay.
But to your question, yeah, the market has been completely on fire from the beginning of COVID till basically now. And part of that is similar to that 2018 push where rates have just been crazy low that whole time and prices have gone through the roof. I mean, the stat that came out last month, just year over year in Bellevue alone, was 80% appreciation, which is just, it doesn't even make any sense. But mind you, there are a couple properties out there that are skewing it, so there's not enough volume to really make at least I don't think a statistically significant number, but it makes for great headlines.
One of the things I caught in there is, if I heard you right anyway, is that the markets typically in Seattle anyways pick up in April, May, and June, and here we are, going into Memorial Weekend, but we're talking about a little bit of a slowdown. So can you elaborate a little bit more?
Yeah, absolutely. And I wouldn't say it's necessarily a slowdown. The market's still we've been operating at a level, an unsustainable level, where the wheels are going to fall off at any time. It's just been so crazy. It's still very brisk, but we've been seeing the mortgage rates come up very rapidly. So at the end of 2021, time is flying, it's crazy, but at the end of 2021, all the economists were predicting that we would see rates in the 4% range by the end of 2022. And at the time, we were right around 3%. So we were talking 1 point increase, which, 33% increase from 3%, but still
a good chunk.
We were artificially low for a while all through COVID. And the consensus on all the experts, that's where it was going to be. And within a month or two, we were at 4%. And then very quickly, we were almost double that, up towards 6%, just very recently. And in the last couple weeks, if you look at the mortgage charts, we started dipping back down. And last I looked, it's around 5.25% is what the general mortgage surveys are saying. Now, everyone's in a different situation, so it's also really hard when you hear these rates. That's not the rate you might get. For example, we had a client last week who was quoted, I think it was like 6.5%.
Wow.
And trying to understand, while other people were in the fives, what was going on. But it's, it was a very complicated nuance in their situation. Their debt to income was pushing up in the upper limits, and while they could get a loan, it was just going to cost them a lot more. So it's important when you hear these rates, it's not really,
right.
That's not a one-size-fits-all rate. But I'm sorry, I lost track.
No, that's okay. I think where you were going is you're kind of showing the importance of interest rates on the market, and actually when we were offline, we were talking a little bit about the impacts of that. You showed me kind of like for each increase by 1% in interest rate, what that meant.
Yep.
Can you talk to that a little bit?
Yeah, absolutely. So kind of a quick rule of thumb, just on the mortgage, the loan side, so principal and interest payment, each percentage point increase on a mortgage translates to about an 11% decrease on your loan balance. So, for example, if you go from 3% to, I think we had it up to 7%, so it's 4% increase, you went from like $1 million loan amount to $700,000 loan amount, which is for the same monthly payment. So that's a pretty big difference in what you can afford. Because especially in our market, $1 million generally gets you a house or a small house, whereas 700, there's not a lot you can get in Seattle or Bellevue for that amount. That's a single family residence. It's going to be most likely condo or very small townhouse.
Yeah. Do you think so? If that's the case, obviously that could mean less buyers for a property, but do you expect that may actually pull prices down, or do you just think it'll be less competitive, when you do find the property?
Yeah, that's a great question. So far, we have seen almost no impact on the rates in the Seattle Bellevue greater market. And I think the function there is there's just a lot of dual income high earners, and so we don't have a lot of buyers who are tapping up against their debt to income limits, and so it hasn't been as much of an issue.
Sure.
I am fearful in the outlying areas where people are not dual income tech jobs and they have actual budget limits. They are going to be very rapidly hitting a limit of what their monthly budget will support on a mortgage payment and where home prices are. Like we have a couple clients who are probably were capping out at like 550 range, which already has us pushed pretty far out of the urban boundary. But we don't know what their new numbers are with these new rates, and so that's likely, if we look at an 11 and 20, 30% drop in price, there's really not a lot to buy besides condos at that point.
Yeah.
And I don't foresee a price correction in that because of rates, and I think there's a couple reasons there. One is just it's really a supply problem right now. So there's not a lot of houses for sale, and there's not enough homes being built. And part of that's just our geography. So like here we're surrounded by water and mountains and all that stuff. And then on top of that we have the Growth Management Act from the 90s that we put in that really limits where we can build stuff. So when you look at other parts of the country, there's tons of new development, new tracks going in everywhere. And here we have some of that, but it's, at this point, that could be an 1.5 to 2 hour commute to urban areas. So people are unlikely to do that. And I think, I don't know if you've noticed it, but I feel like COVID traffic's over at this point.
Yeah.
Yes, it is. We're back to, we can see I-5 up there. It's moving it's moving kind of quick right now, but like 10 miles an hour. And so I think a lot of these people that have moved way out, they might be second guessing that decision once they have to get back to the office. But I think the real inventory challenge in the city here is there's nowhere to build. So we've got urban infill, which is in the form of houses being torn down and turned into townhouses, and in some instances condos, depending on the density. So we're getting more density that way and some more units, but it's just still not enough. And then on the resale side, I think what we're going to see is so many people have houses now that at these crazy low interest rates. So if you got a place at 2.75%, and you live there for a few years and you want to upgrade your house and get a new one, most likely you're just going to buy a new house and rent that out, because you're going to be able to cash flow it, unlike we've been able to do in the past.
Yeah, that's a good point.
And rents are just continuing to go up. So I think we'll see sort of this artificial inventory shortage from people just keeping homes as rentals.
Yeah, that's a very good point.
Which is going to keep more homes off the market, which goes back to basic supply and demand. And so the supply is going to remain limited. So I got a couple theories on, like, if the economy collapses, I feel like we're a little bit protected here, and that is one of them. Is that we've got the rents are so high, people want to live here, that it's an easy rental, so they're not going to sell it. And then the other ones, and we see this with a lot of our clients, is they're putting really big down payments down, and so they've got either money they've made from selling another house, or they have some stock compensation from a company that they cash in, and they're using that for a very large down payment intentionally, so they can get a very reasonable monthly payment.
Sure.
So a lot of these people have been through 08, or on the sidelines in 08 and don't want to see that again, and so they want to get a very conservative monthly payment, so that in the event they lost a job or got a lower paying job, they could still make ends meet.
Sure.
And so same with those people, if the economy was to tank and prices, independent of prices, they would just hunker down and stay in that house, again, not selling, because it's actual real money. Which, I don't know if you remember, in 2008, there were tons of loans where you didn't have to put anything down, and so it's really easy to walk away. But now with somebody putting 40, 50, 60% down, they're not going to walk away from their own money. They're going to stay there. So I think that will further keep supply artificially low, which, I mean, if the whole economy is tanking and everything's going down, this isn't going to raise prices, but I think it will artificially prop up.
Not keep them.
I mean, not even artificially, but it will just prop prices up, because there won't be anything to buy.
Yeah, that's interesting.
And then at the same time, there's always people moving. Like, you have job changes, life changes, moving in and out of town, so there'll always be stuff transacting.
So I got to get your take on something, because this supply demand thing is something we talk a lot about with our clients too, in Seattle housing. That said, so here we are, right in Fremont here, looking across the lake. There's like 4 or 5 buildings going up, all apartments and condos. When those are up and maybe filled, like, still, like, I mean, there's so much building, but it sounds like because of everything you just talked about, even that's not going to offset the
I mean, when you look at the charts of population and new building starts, it's still very, very divergent, and there's not enough. And then what's also interesting, like, we've got a big building going across the street. It's going to be all offices and stuff. But a lot of these buildings you see that look like condos, they're all apartments. And part of that is Washington passed a law 10, 15 years ago on condo warranties, basically. And so what was happening is every condo building comes with a new construction warranty. There's always some building defect where water gets in, the HOA sues the builder, and the builder has to pay out. The building gets covered in plastic, gets redone, and then it's back. Everything's all good. And so what happened is basically nobody would insure any more of these condos. And they were like, you basically couldn't build a condo. And so the only condos left to build are, when you look down at the downtown skyline, are these commercial grade condos, basically concrete and steel buildings that are built like a commercial building, where you don't have like larger house style construction methods. And so when you drive around town and you see something that looks like a small to mid-sized condo, it's actually an apartment building that's just being rented out, individually rented out. And then what we'll likely start seeing in the future is those being converted to condos after they've passed their prime. But yeah, there's just a lot more rental stuff. There's a lot more rental units being built than purchase units.
You had I hadn't thought. You had a really good point too on the fact that if you're paying 2.75% on your old home and buy another one, probably not a lot of selling going on in that type of service.
Yeah, I mean, like, especially when you look at what rent prices are right now, and it was really easy to do the buy versus rent calculation when rates were in below 3 for sure, but even in the 3s, it was a no-brainer to buy. But now that they're up, I think it's still a good decision to buy because you're starting to build equity. I think we will still see appreciation in the low single-digit percentages, I think. And I've been saying for years now we can't sustain double-digit growth every year, but somehow that has been going on for many, many, many years. So this year will probably end up the year with double-digit growth just because we had so much in the first half of the year. But it's going to have to just start tapering out.
That's actually where I was going to go next. So since you already answered that one, for my maybe final question as we start to wrap up, I know you're not, you're not dealing with interest rates all the time, but from your perspective, do you see rates continuing to rise from here for mortgages or just in general, or do you think that might slow down a little bit as well?
That's a good question. They're getting up there. Like before this, I just looked at the chart and I kind of zoomed out to the 10-year. So I usually look at the Freddie Mac, which is one of the government entities that buys the loans. They do a weekly mortgage survey where they poll a bunch of brokers and they get like what the average rate is for a normal product, and with a consistent fee for the loan. And right now they were advertising 5.25 for this week, and you can zoom it out to the 10-year, and we kind of came up and we're down. We're kind of high for the 10-year, but not crazy. Like historically, 5 is still a good rate. Like my first mortgage was at 8 1/8, and I feel like I was refining every 6 months, and we got down to like 6, and I was like, this is amazing. I'm saving so much money. But it's all perspective, right? So I came from 8 1/8 down to 6. I thought it was great. If you're at 3 going up to 6, that's a little bit tough. But at the end of the day, we're going to see appreciation on that asset. We're going to see forced savings. So even though you're making most of your payments interest to start with, you're still putting some of that money into principal, which is basically paying yourself back. And then it's a place to live where you can kind of do whatever you want. So you're not subject to a landlord and all that kind of stuff. So I think so where rates will go, I think we'll probably start leveling out. I think the Fed has moved way too fast on these increases. They went way too fast and hard on the stimulus side, and now they're going way too fast and hard on this side. So I mean, it's like kind of binary correction. And so I think we're about to probably have some whiplash at some point because raising those rates so quickly, like I said, I think we're insulated here in Seattle because we just have such a strong economy, but I do think the rest of the country, I don't know how they're going to be able to handle this, where house prices have gone up everywhere, incomes haven't gone up as much as that, and now the cost of everything is going up very rapidly. So with rates, I kind of think we're going to have to level off here pretty soon and see what the collateral damage is from what we've got. And I don't know, but going back 10 years, we haven't seen any rates this high. Going back, the next chart is all time, and then you start getting back into the early 2000s and 90s and then 80s where it was in the upper teens. I don't think we're going to get back there. I don't think that would be really bad all around. But I do think we'll probably be stabilized here for a little while. Then we might see some more dips. Like if we look back again to where we started talking about 2018, we climbed up to 5, and then we went back down. Then we went up, down, and then now we've gone from 3 to almost 6, and now we're back at kind of 5 1/4 now. Yeah,
that's interesting. And it's funny you bring up this perspective thing because rates have been coming down for 30, 40 years. And people forget that, right? It's like, it was 5, 4 years ago, and now it's 3, so it's great. But really, if you look historically at a 5%, 6% interest rate, like that's still very good.
Absolutely. And I think the thing is, the market did slow down when we hit 5%. But a major function of that, at least here in Seattle, was the Amazon thing. People were still buying houses. And then you look at the price of a house then compared to now, no-brainer investment.
Sure.
Like, the prices are up insane amounts. Obviously there's no guarantee, but I think if you buy an asset where there's limited supply, they're not building anymore, and you still need a roof over your head anyway, it's a great investment.
Sure.
Plus, there's all the other financial benefits of having it.
Yeah, there's tax benefits too,
Yeah.
right? Yeah. Well, thanks a bunch for joining us today. I think this was really, really good. So if anybody wants to get in touch with you or has any questions or anything, is there a good way to...
Yeah, you could just email me direct at rob@bushwick.com or visit our website, bushwick.com. As Brandon said, we do a weekly real estate newsletter it's on MailChimp, so it's super easy to unsubscribe if you don't like it. But we put a lot of work into it every week, and it's really unique content that we recommend checking out. And then I also want to give a plug for Brandon. If you haven't seen his book,
Thank you.
it's actually really amazingly written, and I just reread it recently, and with the stock market tanking, he has some very good insights on downside protection on your portfolio, which nobody has been thinking about for the last several years. And it's not until we're in this bloodbath situation that wish I would have heeded that advice earlier.
Well, thanks a bunch for
Yeah,
that.
absolutely,
for the plug.
absolutely.
And yeah, I subscribe to the newsletter, so definitely check it out. It's very, very helpful. Some really good information. So
Awesome.
Thanks again for joining us today. It's
Yeah,
really good
thanks
stuff.
for having me.
Yeah.
Appreciate it.
Yeah, and of course, if you have any questions for us, you can reach out to us directly, info@mainsailfg.com.